Hey everyone, my name is Anthony Fatsis, and welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming back Alex Gurevich. So, Alex is the founder and CIO of HonTe Investments and the author of The Next Perfect Trade, which will be updated and is actually going to be released very soon. So, it's on the 27th of Jan, which is when this interview is going live. So, Alex, thanks so much for coming back on the podcast.
Thank you. I'm glad to be back. It's good to continue our conversation from a couple of years ago.
Exactly, and as you were saying before, a lot has happened since we last spoke. It seems like decades of news flow and what's happening. But yeah, it'll be really interesting in just hearing and maybe an overview of what you're currently seeing in the macro.
Well, I think like what I mentioned as we were starting our conversation, um, I think at the end of 2024, I said that it was the most boring year I had in my market trading history. Now, 2025 was not at all boring. I would say it was, and of course, no year is truly boring. Boring is only by comparison, but 2025 was quite an interesting year, which there were some, of course, the move to me, the biggest, like in my corner of the world, the biggest thing was the move in precious metals. Of course, for many people who look at the broader world, of course, the biggest thing is the just advances in AI and broad stock market advances. But in my world, probably the most interesting thing was the amazing rally led by silver, but which caught out also by platinum, gold mining stocks, uranium. And this is the move that kind of was, though all those things have been dormant for like a decade or two. It's been a really long time since we had, well, I guess there was a rally about 10, 15 years ago, and now there's the whole new leg of this rally. All those metals were sitting flat for so many years, and suddenly they're on the move. So that for me, that was the interesting thing. And it seems that the fireworks in the sector are continuing as 2026 begins. But of course, there are so many interesting things to look at, looking at interest rate markets going forward and the debates, inflation, deflation debate. And of course, equity will always be interesting for most people because they had a pretty tremendous rally, mostly led by very big mega cap companies. And the history suggests that there might be corrections, but also the history suggests that calling tops of the rallies is very different, very difficult.
Yeah, really interesting. And as you're saying, it's sort of precious metals were a major winner of 2025. Is this just the fact, as you're saying, that it's been a decade, slowly building to the point where we've finally gotten this rise, or do you think there's other drivers behind what we've seen? I know lots of people talk about debasement trade and other factors that could be driving precious metals. How are you seeing it?
Yeah, it's always, I'll be honest with you, it's the precious metals mechanics has been always a puzzle for me. For me, it was easy always to read the charts than to, even though generally in other areas, I'm not a big chart reader, but with precious metals, reading charts and levels seems to be much easier than trying to figure out what is really going on. You can talk about debasement trade, you can talk about inflation fears or deflation fears. Some say precious metals are a hedge against inflation. Some say precious metals are a hedge against deflation because in deflationary environment, interest rates go down and central banks expand monetary base. Some people say that precious metals just reflect purely like amount of liquidity in the system, not necessarily inflation, but just the liquidity conditions of the system. All of those opinions exist. Some of it says just momentum or central banks. Having said that, there is a certain pattern. Precious metals have those slow decade long or longer than a decade long cycles. So you have to have a lot of patience to trade them. But eventually, and it's not uncommon for gold lead the way, and gold led the way, and gold mining stocks even lagged for a while, and silver lagged. This year, actually, as gold even though continued to go up, but the velocity started to diminish, but the mining stocks started to go high. And then silver took on this incredible rally. Even though I was positive on silver, I didn't expect it to go to 90s. That was not my plan. I thought 50 or 60 was pretty ambitious target for silver. And then we're seeing in the 90s, just the same as gold. My conservative target for gold was 3,000, and now we're seeing is almost 5,000. And I believe that like platinum will be next in the rotation, that platinum is only beginning to move, even though it is more than 100, like almost 150% of the lows. But I think that's platinum is pretty early, and that just the history suggests metals have this massive several-fold rallies once in a decade and a half, and then they usually have like long periods of corrections and kind of dull performance. And then if you load up on it during the dull performance, you just have to wait for the next big rally. It's not uncommon. It's historically consistent.
Yeah, okay. I guess the challenge is that patience, as you said, it was sort of over a decade of up and down, range bound basically until it broke the 2000s. And then we've seen appreciation the past few years.
I remember us joking how gold always had like 1100 or 1200 handle on it. Like in the tens, right? Like it was forever, like 1100 something, 1200 something, and like if gold went to $1,300 an ounce, people would go crazy. That's like a great rally. And now, of course, it's quadrupled from there. So yeah, it's kind of a mystery how those things move. But I think like with good patience on those things, you can get a good return on capital. If you invest at low levels and patient, like think about quadrupling money on gold if you invest it right. Like you cannot imagine that you will always do it like exactly when it started moving, like invest on gold 3 years ago or something. You would have to invest on gold 10 years ago and sit on it for 10 years and then quadruple your money. That's kind of the medium scenario. And same kind of similar situation with silver, right? But quadrupling your money in 10 years is not a bad return on capital. It's okay. It's quite acceptable return on capital.
Yeah, definitely. And people go back to the 2000s or even earlier and they say that gold's outperformed the S&P. So it's actually done reasonably well if you hold it for the period of time.
Right.
Yeah, really interesting. So you mentioned also rates that you sort of there's this as you said, there's quite a lot of people on both sides of the fence. They're saying some think there's going to be inflation's going to stay where it is currently, or maybe go up a little bit higher above the target. Some think we're sort of going to get into a disinflationary period of time where as the economy slows down. What are your current thoughts on what we're seeing? And what you
Well,
expect?
I fall into the disinflation camp, but I also recognize that there is arguments been going on both sides, and over different periods of time, different camps were incrementally right. Like if you go back to post-COVID, team transitory proved to be wrong, right? Because the inflation was, and I was on team transitory and I was wrong. I thought inflation would be more transitory than it turned out to be. But then inflation turned out to be more pernicious. The rates had to go higher, much higher than I expected in 21, 22, and a little bit in the beginning of 23. Now in 23, some people were still like calling for rates to go up to 7, 8%. And at that time, things started to turn around, and people who called for rates to go down are kind of right because Fed started to cut rates. And it is, by the way, not uncommon for the curve to steepen and long end resist at the beginning of easing cycle. People are all talking about as like a proof that there is an inflationary problem. No, it's not proving anything. Long end selling off, it happened in 2001. It happened in many other situations when Fed starts to cut rates, long end could do whatever it does. It doesn't say anything about inflation. It has no predictive power. It doesn't indicate anything about what the economic state. It just indicates where the buyers and where the sellers for long-dated bonds. And if there is less buyers, the yield on long-dated bonds goes up. So that's first thing to remember. As for the front-end debate, you could kind of argue that the front end started to grind down, and the inflation is leveled at least. Now, the question here is some people hold the view that like inflation will be persistent and it's still above target and it's still self-feeding. I consider that since real rates have been positive for a while, there is no longer positive feedback mechanism on inflation, and we're taking some deflationary processes involving job loss take hold. Then other people make counter argument about fiscal stimulus and fiscal impact, that fiscal impulse makes up for any lack of final demand, and of course also all this infrastructure growth related to AI and capex also created final demand. So there hasn't been any slowdown yet. So you just gotta keep going back and forth between those factors. But I'm seeing a slowdown in job market, and I think that slowdown will continue. I expected it even without AI, and AI is kind of probably going to exacerbate over the next couple of years. So in the end, I think lower rates are the destination.
Yeah, okay, interesting. And then that would, I'm assuming you think that the lower employment or decreasing employment would then lead to a recession, or at least a slowdown in what was currently seen in the economy, or how do you sort of link those two together?
That's a harder question because these days, basically, that if you look at like three things like labor market, economic growth, and stock market, they used to be all people. I think pre-COVID even people used to view them as a package. I've always questioned the packaging of those things, that they have to come together. Like I always said, like why does stock market have to sell off if there is a recession? There is no particular reason, because except for those few sectors that might be particularly hit by this type of recession. For example, like in global financial crisis, yes, banks got hit. In COVID, yes, travel companies got hit. But the Googles, the Amazons, the Microsofts of the world, why do their stocks should go up or down depending on whether there is a recession? And furthermore, why does it have to be recession when job market slows down? Those factors, the answers to those questions are not actually obvious to me. So what happens in what really drives markets is liquidity. So if we have an economic slowdown and there is a shortage of liquidity, less cash in the system, there is less buyers, and stock market starts going down. On the flip side, if less people work, people lose jobs, people have less money to buy stuff, that might lead to recession. And conversely, recession means less people being hired because the companies have see less demand. So yes, all of those things have interlinks, but any of those interlinks can be broken and unintermediated by fiscal intervention. For example, what we found out on COVID is it does not matter if there is a recession and people are out of work. If you just send everybody a check, there will be liquidity and the asset markets will still go up. By the same token, you can think, can we even have a real slowdown in the job market and no recession? Can we have a recession with continued stock market rally? So I feel like it's really hard to see those things as an unbreakable package now, given the amount of fiscal intervention we've been seeing.
Yeah, it's a great point. And I think that's something that people realize that, the Fed, people used to think interest rates were the only tool they had. And then they brought, out QE, QT, et cetera. And then they just seem to be find new tools that they can utilize, get around the laws and their mandate to actually be able to keep what's happening going. So I think that's why we've seen, you see these really small crashes or these really quick recessions. And it seems like that's probably the future as well. You're just going to see very small crashes until the Fed comes in and tries to save things.
Possibly, but then there is also a part of me that says, well, it's very dangerous to say this time things are different, because ever since like even the beginning of 19th century, there was multiple episodes when people would get to the point of saying, we've reached a permanent plateau, stock market can no longer go down, and there's for XYZ reasons, and we will not have recessions for XYZ reasons. And then something happens and you have a protracted recession and a protracted bear market. So every few years, something really unexpected happens. And can we have a deflationary event happen, disinflationary event happen, which will overwhelm the monetary policy and fiscal response, at least at first? I think it is still possible. And I wonder if some kind of like backside of AI can do that way, by like job elimination from AI will be so severe, and not just job elimination, but even like economic activity elimination from AI, because so many things that people used to go and pay money for, now they're getting for free from ChatGPT or Grok or whatever they're using. So if that elimination of economic activity will hit the economy, so kind of blindside the economy, maybe we might even have a recession, actually, paradoxically.
Yeah, it's really interesting, especially when the economy is driven by consumption, as you say. So that could really impact it. But how do you see? Because there's lots of obviously geopolitical noise, or there's lots of noise, at least in the markets currently, about what's happening globally, US first world, etc. How do you see this, or is this something that you just sort of look through because it's obviously impacting the markets in the short term, but not in the longer term? How do you brace yourself?
Well, I tend to try to look through the geopolitical noise. Of course, it's not to be neglected. I find that politics and geopolitics are very hard to trade and usually should be faded. So moves inspired by some kind of political or geopolitical rhetoric, like if some assets make an extreme move based on it, it's usually I prefer to trade the other way, incrementally. I'm not gonna like die on the hill of fighting geopolitics, because there are times when political shifts really led to really major asset moves. Like, for example, the government shifts could lead to very big asset moves. Like Japan, in my trading career, twice had a massive weakening of yen due to government shift. One of them recent, another one back in 2012, 2013. US, when US had like the government shift in 2016, it led to 2-year bear market in bonds, strong bull market in stocks. Now that bear market and bonds turned around eventually by 2019, but it was meaningful. It was not to be ignored. So I'm not saying that any political shifts have to be ignored, but I think generally, like geopolitical noise and geopolitical fears over the course of decades, my experience is that it's better to trade in the opposite direction.
Yeah, interesting. I guess it's those secular shifts, but then the challenge is how do you know if this time is that shift, as you said, the Japanese bomb was known as the Widowmaker, and now we're seeing it massively.
Yeah, like it was
Yeah, yeah,
Widowmaker one way, now it's being the Widowmaker the other way, right? So
exactly.
I think I would say that my approach is to trade in the opposite direction, but very cautiously. Unless you feel like, on occasion, unless you feel that there is a lot of value in the trade to begin with, and the political shift is a catalyst. For example, in 2012 to 15, I got it right when I actually, in this book that I am doing the second edition of, The Next Perfect Trade, I discussed a lot, talked about that trade. I thought that yen was overvalued, and when the government shift happened with Abenomics, and the yen weakness trade came on board, I was totally on board with this trade. I ran it. This time I was not on it, but you cannot catch them all. Like the yen weakening, that from like post-COVID to now, I didn't really trade it right. I was not on top of this yen weakening, but and now I think yen is too weak, so I want to go the other way. So the key is there to just be cautious.
Yeah, okay, really, really interesting. Are there any other trends where you're seeing which you just don't think look right currently, or you think are sort of due for, or that interest you at least?
Well, I think so there are some interesting currency valuations, right? I think recently Chinese currency strengthened a lot, yen weakened a lot, Swiss francs strengthened a lot. So there are some, I'm not gonna go into every like little detail of what you should sell, what should buy, and how much, but I think you can watch for currency dislocations and maybe create some strategies around that. I think the interesting trade is bet on lower interest rates. To me, that's the interesting trade. Again, in what form and how you're going to do it, that's a separate question. But to me, it is interesting to think of lower interest rates. And of course, that is a speculative trade in the sense that there is no ironclad rule that tells you that rates have to go lower. But this is kind of what I see right now. And of course, it's very interesting to think about equities on this situation, because again, I'm seeing a conflict between the idea that equities can go up for as long as they were going to up right into everybody's face, and the fact that they always somehow, for some reason, go down. And if you see a long bull market, no matter how much of it you missed or fought against, several years down the line, there is always a chance to buy stock market once again cheaper. It just seems to be the rule. And again, maybe this time will be different and there will be never a chance to buy stock market cheaper. But based on history, we should still be able to buy S&P 500 at 4,000 at some point, or even cheaper. And how it's going to get there, I cannot comprehend. But I think it is because neither me nor anyone else can comprehend how stocks can get that low. It kind of almost increases the probability of them getting that low because few people are positioned for that.
Yeah, it always comes back to the mean. And I guess the challenge is, as you said liquidity drives markets, and it seems like it's going to be very, there's going to continue to be liquidity, I guess, pumping into the economy and pumping into the world, especially as we see the deficits. Do you agree with that or no?
That seems to be the trend. The trend seems to be towards liquidity. The only thing that I would say in the developed world, other than possibly Japan, right now there is like this inflation fears. So monetary policies are gonna, because of like people always like close the barn door once the horse is out, right? So central bankers are currently incrementally more fearful of inflation as they should be than they should be because they just experience inflation. Now, Japanese are still on the opposite. They're still in the fighting deflation mindset, and their psychology is changing slower because they've had such a long deflation disaster that now that they're seeing inflation, they're not really ready to fight it yet. They're kind of good, some inflation, great, right? In US, inflation got really out of control for a couple of years, and people are in this fearful mode, and that makes me think that might create a deflation risk because as deflationary pressures rise, monetary policy might be not fast enough to respond, and even fiscal policy response could have a little bit of a pushback because of, hey, you're creating inflation. Now, having said that, when we're really in deflation environment, not disinflation but deflation, if we get into negative inflation, I'm sure there will be people will get panicked and there will be all sorts of strong responses. It's just a matter of lag.
Yeah, interesting. I guess what we're seeing now is that multiple economies are going in different scenarios at the same time. I'm not sure if you've seen that, but it seems Europe is quite different to where the US is, and then the US is quite different to where China is. As you said, that's a real good example of sort of deflationary challenges.
Yeah, so China is interesting because it seems to be doing okay in its asset markets, but the growth is not doing super well there, and they're facing deflationary challenges. Meanwhile, the currency is grinding higher, not lower, right? And if you look at like China to Japan currency ratio, it's really extreme levels, right? If you think of them as export competitors, but that doesn't seem to be bothered right now, China, because the exports are still doing fine. So what measures will it take? It's just like, it's harder for me to understand them because when you go about like a very classic open currency economy like a Euro or UK or US, you kind of see it simply, okay, deflation, they're going to cut rates. That's probably going to lower the currency, right? You can kind of just have this simple mechanism, but in China there is like all those like internal rules and regulations and stimulus policies and the ways they can control and manipulate the economy. I'm not even meaning it in a negative way. I'm just stating it as a fact. That it's kind of hard to understand what's going to happen there. I do think they're going to have to. They're likely to stay stimulative, and it's probably this rally of RMB probably will not hold up later in 2026. If you put a gun to my head.
Yeah, okay, interesting, and it does seem like the West is moving to sort of a similar economic, government-led, economic, fiscally driven economy, similar to what we're seeing in China.
Yeah, and that makes equations much harder, right? Because it makes equations much harder because, for example, if a government makes a fiscal push and expands its spending, but then immediately interest rates respond and bonds of that country go down, that retightens financial conditions right away, right? So like it's hard to calculate what is really happening. And while with monetary policy, you can kind of see like, okay, next meeting, the Fed will do this, ECB will do that. Fiscal measures are just harder to qualify or understand, at least for me. Maybe somebody else has easier time with it. For me, fiscal impulse is just more multifaceted and confusing.
Yeah, you don't really have an interest rate sensitive borrower, because at the end of the day, they can just print the money and they can keep lending. So it actually doesn't really slow down inflation as much as, I guess, the average person who's taking out a loan, or a company taking out a loan, that would have more of an impact on, I guess, the economy.
Yes, I think if you look for, I think real rates have strong impact on the economy because when real rates are high, businesses have incentive to contract their balance sheets, and that reduces the liquidity overall in the economy. When real rates are low, for example, back in the 21, 22, when real rates were like -9%, businesses had incentive to like borrow money and buy up inventory like crazy, right? Which is only accelerates inflation. As real rates go high, businesses have incentive to work on their productivity, reduce their headcounts, reduce the debt. That's a very natural process. As you pointed out, US government doesn't really have such constraints. US government has no debt because it just owes money to itself, right? It's nonsense to say that US government has a debt. It's in dollars, right? So every dollar in some sense is a debt of US government. So like whether you issue a dollar or government bond, it's the same. It's just we issue bonds. We don't owe them to anybody. It's just an issuance. So the only question is how much money US government can print without creating catastrophic inflation. And that's the balance, right? And we found out that into 21, 22, that we cannot just send checks to everybody and not expect inflation to happen.
Yeah, really interesting. And I guess another key theme at the moment has been the dollar, and the dollar had sort of quite a weak year last year. Was sort of one of the, I guess, against basically most currencies. So is that something that you think is going to continue, or do you have any opinions on whether that could sort of reverse?
I think it could reverse. I think dollar is showing signs actually of stabilizing the way I look at it. I don't think like people were very caught up on the weak dollar. I think really the move was not in dollar. The move was in precious metals against everything else, all currencies. But dollar, honestly, dollar just came from very strong levels, and dollar is still. If you look like dollar versus various currencies, if you look dollar versus euro, it is still mid-range leaning to the strong side. So yes, it weakened from the extremely strong devaluations for the dollar against euro to something which is more normal, but still dollar is probably still on the stronger side. And dollar yen is the highest it's been in the recent history, right? Extremely strong. And dollar China has weakened a few percent, but really it's close to the places. Dollar China is not really that volatile, right? It just moved a few percent up, a few percent down, but fundamentally it's kind of staying where it is. So if you look at all the major economies, dollar is not particularly weak. It's just the illusion of weak dollar it's not the illusion of weak dollar, but almost like the experience of weak dollar is not from dollar going down a few percent against euro. The experiences of all assets, including stocks, and there is real estate not so recently. I mean, real estate kind of slowed down, but there are previous runs up in real estate, runs up in stocks, runs up in precious metals. All those things which are valued in dollars got much more expensive, which creates this experience of debasement. But that would be true if you were valuing them in any currency, really. It's not like gold didn't have a bull market in euro terms.
Yeah, it's as you say, it's and Michael Howe, who I quite enjoy, looks at liquidity, and he says that the Chinese yuan they're looking to devalue against the gold, and maybe that's the same for the US dollar, maybe that's the same for every currency. They're looking to devalue against gold. I guess the hope is that they're just accumulating gold at the same time. To
Right.
yeah,
Well, I hope you always hope that people who make wise decisions in terms of assets, but that is not often the case.
yeah, exactly. And you mentioned that you're sort of re-releasing your book. So why did you think it was important to bring it back now and to sort of re-release it?
Well, it's been 10 years since I've published my first book, The Next Perfect Trade. And then I thought it was a good time to review how my strategic system actually worked over the last 10 years. So the goal was not only to make it a little prettier, because the first edition was very like independent and not super polished. Now I have I'm going to show you, this is the cover of the new edition. I feel like this book has really nice, good readable graphics, really nice formatting, really nice organization. But what I did on purpose, I did not want to change much in my original text, because I wanted people to see what I was thinking in 2015 versus what I'm thinking in 2025. So instead of rewriting what I was saying in 2015, I just added some passages which I call notes from 2025, which is clearly delineated, and you could see look, this is what I thought back then, and this is what happened. This is the strategic discipline I proposed, and did I adhere to it or not? And I have plenty of examples, right, that I've done in this edition where I actually failed to follow my own strategic principles, and examples when I actually succeeded really spectacularly following them. And I think it is a good exercise to do this revision and this kind of retrospect, because when you lay out a system of strategic principles, it's very backwards looking. When I wrote in 2015, I talked about the perfect trades of 2002 and 2014, which I've done in the past. And I wrote about things that have worked in the past relative to where I was back then, right? So, and now we have a next decade to, now we had a decade to see, do the strategical principles make sense by projecting them forward? And this new edition allowed me to capture this and write notes and discuss how those principles held up over the last decade.
Yeah, and how has it sort of made you sort of change the strategy, looking back at the results and what it led to?
Fundamentally, I would say that I adhered to those principles. I have a more rigorous, compared to when the book is published, I have a more rigorous, I would not say like algorithmic, but more mathematical way to adhere to the principles which I laid out in a more qualitative way in the book, The Next Perfect Trade. I have like the ranking systems and portfolio ranking systems right now based on this. But so I generally followed the strategy, but I also delineated. There are some places where I deviated. There are some places that I might have decided to do things slightly different compared to how I outlined in the original book. Yet I think fundamentally, if you read this book from 2015, you will still have a good sense of what I'm doing, and a good sense what worked for me in the past and what continues to basically working for me. But there are definitely some significant variations, and which are interesting to discuss. And a lot of those variations had to do with just my own intellectual or psychological discipline. You can only be as good as you can be. Like nobody can achieve perfect discipline.
Yeah, exactly. So many great points. So Alex, thanks so much for your time. We've sort of covered so much about what's happening in the world and the new book. But my last question is, what is one message you want people to take away from our conversation?
I would just say, well, in the spirit of my book, look for your perfect trade. I mean, do not try to see the forest behind the tree and just see. That is my approach. Try to see the forest behind the trees and find what is the trade that will give you multiple return with sufficient patience.
Yeah, great message. So thanks again. If anyone wanted to find out more about your work and what we do, where would the best place for that be?
Well, I could be found on X. I'm active on X, and but you could also look at my company website. I'm showing you the cover again. My company website is HonTe .inv, so HonTe.inv. And you could find the various references to my publications, articles which are publicly available over time. Only qualified purchasers can actually register as potential investors. So I'm not right now advertising any investments. It's more about, but people could find various publicly available information on my company's website. And the book will be out at the same time as the book will be out at the same time this podcast is aired. So please push the buy button. If you read the first book, I think you'll find value in rereading this and seeing the edition. If you have not read it, I hope it will be helpful to contribute to strategic thinking.
Yeah, great. Thanks so much. I'll put that all in the description below. And if anyone wants to buy it, I'll put a link there as well. But yeah, thanks again for your time.
Thank you very much. It's a pleasure.
Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right. Thanks again.